Hello, I'm Mike Hetman and welcome to another edition of CMS Forex News. Today is Friday, March 14th, 2008. Inflation in the Eurozone was revised up to an annual pace of 3.3% in February from its preliminary estimate. This is a record high for the Eurozone. Inflation for the month was up 0.3%, in line with expectations. The European Central Bank has made it known that their primary concern is combating inflation, even as some corners demand for interest rate cuts to help bolster the economy. The labor cost index for the Eurozone for the fourth quarter rose to 2.7%. This was higher than expectations and further complicates the inflation picture for the ECB. Wages are rising, and the ECB now has little room to stimulate the economy with any kind of rate cuts. Hopefully, economic data from the Eurozone in the next month does not point to a sharp slowdown. In the U.S., inflation was flat for the month of February, the first time that has happened since November 2006. The annual pace of inflation cooled to 4%. This is a welcome sign to the Federal Open Monetary Committee, as it has abandoned trying to keep inflation in check using monetary policy and has solely focused on boosting growth with their rate-slashing campaign. The logic being, if the economy slows, then inflation will cool as well. The euro-dollar pair rose following the inflation news from the U.S., as it implies the Fed will not alter course in its approach and is ready to cut rates aggressively in its meeting next week. The ECB will most likely hold rates steady as long as inflation remains a problem. The pair touched a new record high at 1.5687 and has gained more than 250 pips from the start of the week, with most of the gains coming on Wednesday. The pound-dollar pair also rose today, though it turned back at resistance near 2.04 and fell in what looks like a round of profit-taking. The pair is set for another weekly gain. Looking at the past 2 weeks, we see that the pound has climbed 430 pips, with a small correction earlier this week. The dollar fell versus the yen today, going below the 100 level for the second time this week. The yen strengthened as risk aversion hit the investors on news that Bear Stearns needed to be bailed out after the firm's liquidity deteriorated significantly in the past 24 hours. The news sent the company's stock down as much as 40%, causing declines in the broader indexes. In this look at the pair for the week, we see the pair is testing support at 100 yen per dollar, an important psychological barrier. If U.S. equities continue to perform poorly, the pair is set to break down below this level next week. The dollar is down around 280 pips from its weekly open. The dollar-Swiss franc pair hit parity for the first time ever. The Swiss franc, similar to the yen, is used to fund carry trade, and today's increase of risk aversion prompted investors to sell higher-yielding assets funded in Switzerland. Also, with the U.S. set to cut rates, the Swiss franc is going to enjoy a higher yield compared to the dollar. For the week, the pair is down around 200 pips and seems to be set for further declines next week. The most important fundamental event next week is the FOMC interest rate decision on Tuesday, in which the Fed is projected to cut rates by 75 basis points to 2.25%. Tuesday will also feature consumer inflation data from the UK and Canada. And this completes Forex in the News for Friday.